Hello everyone, let us continue with our discussion. So in the previous lecture we have covered up our equity, we have covered up our fixed income. Okay, now one more we have also covered up, that is our real estate. Now it's time to go for the next investment, that is your exchange rate. You invest in the forex currencies, clear? So then you need to forecast the exchange rate. Like suppose you have invested in rupees 5 years back, so which was trading at say rupees 70 per dollar, clear? But now it is trading at rupees 90 per dollar. So if you have invested at that time and now you would have received it your money back, you would have made the return. But for that you need to make the forecast that whether rupee is going to depreciate or whether the rupee is going to appreciate, clear? So what we need to understand is that first of all the currency is moving, clear? So we need to forecast that why this currencies move, clear? And why forecasting them is so difficult, clear? That we are going to cover up. We'll start one by one, clear? So why currency exchange rate forecasting is difficult? Okay, see, forecasting currency movement is one of the hardest job in finance. Why? I tell you the reason. Because currency affects your everything, your stocks, your bonds, your real estates, your imports, your exports. Clear? And your exchange rates are influenced by the trades, your government policies, interest rates, capital flows, then laws, regulations, culture, and even the geography as well. Clear? So currency is simply the unit in which prices are quoted, like INR, USD, Euro. So if exchange rate will change, the value of the asset priced in that currency will also change. Like I have my asset in US, clear? And that asset is worth say $100, clear? For me, what is the value of that asset? I'm in India. When the exchange rate was rupees 70 per dollar, clear? Then the value of that asset to me in India is 7,000. But now this exchange rate increased to 90 per dollar. I haven't done anything to my asset. It's still the same. Value of the asset remains the same. But now the same asset to me is 9,000. Now I'm more richer just because of the change in the currency. Nothing else happened. Nothing else happened. So I have just made the return just because of the change in the currency. Are you clear? So now if you look at from the investor's perspective, either they accept the volatility, this is their first option. Their second option is to hedge the currency risk. Okay, they will enter into the trades, whether it is the swaps or whether it is the futures, but they try to protect themselves through the hedging. And if they say that okay, we are comfortable with the volatility, all ups and downs, then they don't do any hedging or they don't enter into any such trades. Clear? So again, exchange rate moves because of the government policies, capital flows, financial market, geographies, and the local laws as well as customs. Clear? That's why it's very hard to forecast. You have to forecast so many things. You have to forecast the government policies, their trades, their capital flows, financial market, geography, other countries also. Because see, you are forecasting rupee per dollar. So you cannot just forecast about the rupee. You have also forecast about the US, that how US is going to behave, how the capital market flows will behave in the US with respect to India. All these things require forecasting, and that's way too huge amount of data, huge amount of information. Okay, so let us enter into exchange rate forecasting. So there are the three main aspects which actually leads to the forecasting. One is the trade flows between the two countries, that is your import and export. Second is your purchasing power parity, and the third one is your current account balance. So we will start with the first one, that is your trade flows. So what is trade flows? If I'm talking about my own country, clear? Net trade flow, import minus export, clear? Or you can mention it like this, export minus import as well, clear? So if a country export more, if I am exporting more to the US, clear? That means what? I am getting more USD, clear? I am getting more USD, or the foreign buyers, they need more Indian rupees so that they can purchase my product. So in any manner, the demand of the rupee is going to be high. Clear? Either I am getting dollar in my country, clear, and then I am converting the dollar into rupee, so I am getting more rupees, clear, or else they are buying the dollar, they have the dollar, they are converting it to INR and they are paying it to me, clear. So means what? The demand for my currency will increase, clear, and hence the currency will strengthen. If the demand for my currency will increase, then currency will strengthen. Like, what is the rate? 90 per dollar, clear. Now what happening? They are coming, suppose 5 traders are coming to the market, they have dollars. Now suppose there is a shortage of rupee in the market, right now they are coming up with $1 to get 90 rupees, clear, but shortage of rupees. Now they have to pay $1.1 to get 90 rupees, then $1.2 to get 90 rupees, $1.3 to get 90 rupees, clear, because they are bidding. Like, there are 5 people in the market and suppose there is only 90 rupees available in the market. I bid that I am ready to pay $1 to get 90, but you came and you say that everyone need the money, so you will say I am ready to pay $1.1, give it to me. I am ready to pay $1.3, give it to me. So now what's happening? Now it is rupees 90 per $1.3. Now if you will calculate it for rupees 90, it will reduce. Means what? Your currency has appreciated because of the demand for your own currency. Because of the demand for your own currency, and hence your currency will strengthen up. Are you clear? But in reality, trade flow alone will have a small impact if they can be financed. Okay, sometimes the trade are financed, not paid directly into the cash. Clear? Now these 2 points are important and we need to understand them in detail. We cannot take them lightly. Okay, imagine you as a country. Okay, means I'm going to take one example so that you will understand it. Clear? So now suppose your monthly income is 50,000, clear, but your monthly expenses are 70,000, clear. Now you have a deficit of 20,000, clear. Now there are 2 cases, clear. You have the deficit, that is for sure. So 2 situations, one is safe, another one is danger. Which one is safer side? Safer means you have covered these 20,000 rupees which you have spent extra through credit cards, loan from the parents, EMI from the bank, anywhere you got the money, clear. So you are spending more than you earn, but you can still survive because money is coming from outside, clear. So for the countries, it is simply similar to import is greater than export, clear, and foreign or else foreign investors will lend you the money, clear. That means there is no crisis, life will continue smoothly. But danger comes when banks will stop your credit card, parent refuse to lend, loan is getting rejected, clear. You earn 50,000, still you need 70, so to 20,000 extra, you have to cut your spendings, or you have to sell some of your assets. So it will become a panic situation, and hence it's a danger, clear. Hopefully you understand. So from a country situation, so moving ahead from the personal to the country situation, country imports oil, electronics, foods. What they need USD. Exports are lower, so you earn less USD. Means suppose this is your bank, clear. You export goods, that means what? USD is coming, clear. You import goods, that means what? USD is going out. Suppose your export is less than the import. Suppose your import is $100. Export is $70. So if you have received $70, you have to pay $100. That means what? There is a trade deficit. There is a trade deficit, but if financing is possible, then foreign direct investments, FDIs, okay, foreign portfolio investments, foreign loans, bonds which are bought by the foreigners, they will give you additional $30 so that you can cover up your $100 from 70 from the export and 30 through your remaining 30 through your FDI, foreign direct investments, FPI, foreign portfolio investments, foreign loans, clear, or the bonds which are bought by the foreigners. Are you clear? Now, what will happen to the currency over here? Clear? Now, India, we all know that we import oil, we need dollars. So, if foreigners, investor will stop investing, no foreign loans will come. Now, the demand for the USD will increase, supply for the USD will decrease. Are you clear? Demand for the USD will increase, supply for the USD decrease. Then INR will fall, or you can say depreciate. Write down. India import oil. If you'll write it down, it will be the part of your notes. India import oil. Clear? So we need dollars. Clear? Now foreign investors, if foreign investors will stop investing, if foreign investors will stop investing, or no money, no foreign loans is coming. Clear? Now the demand for the USD is increasing. Clear? What we'll do? I have my reserves of rupees. I'll go to the exchange and I'll say that I am giving my rupees, give me the dollars, because I have imported the oil, I need to pay the dollars. Clear? So the demand for the USD will increase and the supply will reduce. Clear? INR will fall, or you can say INR will depreciate. INR will depreciate. That's why India will come under pressure. Now central bank will use their reserves. If reserves will fall too much, then it will lead to the crisis. If reserves will fall too much, then there will be crisis. Clear? Like I'll give you one example of Sri Lanka 2022 crisis. They have a huge imports for fuel, for food. Their export have started following. Their foreign borrowing stopped. Their foreign reserves collapsed. And the result, their currency crashed, inflation explosion, fuel shortage. Not because the import were high, but because imports were not financed. Are you clear? Now, moving ahead from trade flows to the purchasing power parity. Clear? Write down. Purchasing power parity, write down. The same basket of goods should cost the same. The same basket of goods should cost the same in all countries after adjusting for exchange rates. Adjusting for exchange rate means if I'm considering one bread and one butter in India, suppose it cost me rupees 180. Clear? Now if I'll go to US and I'll take the same bread and butter, it should cost me $2 considering the current market rate. Clear? So countries with higher inflation, then the currency should depreciate. They should lose value. Like I'll give you one example. Inflation in India is say 6% and inflation in US is say 2%. Then INR is expected to depreciate by 4%. All these things we have studied before. So real exchange rate should stay stable over time. Clear? So over here, the important points which you need to consider is that purchasing power parity works poorly in a very short run, but it works better in a very long run. Clear? So when it works best, there are two conditions. Number one, when inflation differences are large, clear, and inflation is driven by the money supply. If these are the two cases, then your purchasing power parity will give the right estimation. First, inflation differences are large. Second, inflation is driven by the money supply. Clear? Exchange over here. Clear? Works better in the long term but not in the short term. Also at these 2 points, also it works best when inflation differences are large and inflation is driven by money supply. Clear? Now there are few limitations which purchasing power parity does not consider, like capital flows. Okay, then it also don't consider the trade barriers. Non-tradable goods are also not considered. Clear? And economic development differences, these things are also not considered. Clear? And the next point is about your current account and your exchange rate. Current account means what? Your trade balance and the flow of the income. So when capital movement is restricted, then your exchange rate depend more on the trade balance. Like, it's not how big the current account deficit is, but how long it lasts. Clear? Now, your current account imbalance also depends upon multiple things, like your availability of the resources, like whether you are rich in oil or poor in oil, demographics, okay, whether you have the aging population or the young population, that depends upon the earning abilities. Clear? Saving habits, how much you save, how much you invest. Fiscal imbalance, if the government deficits are high, it's very hard to manage for the long run. Clear? Investment opportunities, if suppose there are not good investment opportunities, then how you will invest and make the money? It's very hard. Okay, what are the terms of trades, like export price what versus the import price, tariffs, and everything is the part of it. Clear? Now our next point to be discussed is capital flows and exchange rate. Now this covers three important concepts. First one is the capital mobility. Capital mobility, see the word mobility means how freely money can move across the border. Clear? So expected percentage change in exchange rate, expected percentage change in exchange rate depends upon two things. First one is your interest rate difference. Interest rate difference. Clear? And second is risk premium difference. Risk premium difference means if two countries like US and India, clear, and their exchange rate is differ by 4%, but India is considered to be more risky as compared to the US, hence that will also taken into consideration when you are calculating the foreign exchange rate. Clear? So when a country suddenly become attractive, there are three different phases. Okay, first phase is immediate appreciation, means foreign investors will rush in, then the currency will strengthen fast. Second phase is overshooting, you can initial sharp appreciation, okay, immediate appreciation. Then second is overshooting, currency becomes too strong compared to the fundamentals because huge amount of money is coming. Now long run depreciation, when fundamental will normalize. So when investments will mature, then currency will started slowly weakening. Clear? So this explain the whole exchange rate overshooting, because the moment the money will start coming into the market, India INR versus USD. So US people are coming to India. Okay, they are purchasing huge amount of INR, because they have to invest in India. Hence the INR will appreciate. But later on, after a point of time, it become normal. Okay, things will get normalized. So capital mobility, how it is important for the exchange rate calculations. Clear? Coming to the second point. Second point of discussion is uncovered interest rate parity, means exchange rate is equals to the interest rate difference, means they are not considering the risk premium. Clear? But in reality, but in reality we have a carry trade. But in reality we have a carry trade. Clear? Carry trade means what? Borrow in the low currency and invest in the high interest rate currency. Like if I'll borrow from the Japan, okay, Japanese yen, and then I will invest in the INR. Clear? So carry trade works because it earns a risk premium. Clear? And that is the benefit. So what it shows that if there is risk premium involved, that means uncovered interest rate parity is not at all involved. Okay. Now there is one more concept. The concept is of hot money. Now what is this hot money? It is a short term speculative cash flows. Okay. These are the fast cash inflow due to the rate difference. Now it can create few problems, like central banks will lose the monetary control. Means this is India. Okay, RBI controls the flow of the cash. But what if huge amount of money is coming from US, China, Japan? Huge cash supply in the market. So what happened? Central bank have lost the control on the supply of the money. Clear? Firm will borrow short term for the long term projects, because they know that the long term financing is costly. So they will borrow for the short term. Clear? And they will keep on refinancing it, but it's a high risk, because suppose you have suppose you have taken the loan for 3 months, then after 3 months you have to repay the loan, you have to take it again. Now you have to repay the loan, that is for sure, but what if you will not get the money after 3 months to refinance that particular project? So it will create a huge amount of risk. Clear? Currency rates will overshoot, and that leads to the business disruption, business instability. Clear? So central bank will respond by generally selling their government securities to keep the flow of the money intact. Okay, they intervene in the foreign exchange market. Clear? Or they will also control the interest rate, which is increasing or decreasing gradually. Clear? So hot money is just a short term money which you have to control. Now the next point to be discussed is our portfolio balance and composition. See, as a country will grow, its asset will become larger part of the global portfolio. Clear? Because investors are engaged, they will hold more assets, and that will lead to the weakening of the currency. Clear? But this investor will get reduced if investor will show the home bias. Means if I'm an Indian, okay, rather than investing in US, if I'll prefer to invest in my own country, my country will strengthen up. Clear? Growth will come from the productivity improvement. If I'll produce more, clear, I can export more, my country will grow. Clear? Country small and emerging. Clear? Still your weight is going to be higher with respect to the investment, with respect to the currency. Clear? So what should I focus on? Strong GDP growth. Clear? So country gains higher share in the global portfolio, because if your GDP growth rate is high, then investors will come and approach you and they will invest your money. To attract more investment, what I need to do? Currency will be weakening, and that leads to the higher risk premium. Means suppose my current value is 90 per dollar. Clear? Now if I want to attract more investment in India, what I'll do? I'll say to the US people, come and bring your $1. Earlier it was value 90, but now it will value at 1010. So now you can buy more assets using the same dollars. So that is more encouraging. Clear? To bring the money, foreign money into our country. So these all are the points which the author have discussed in the currency, or you can say the exchange rate forecasting, the problems associated and different models and methods. Clear? So I'll keep this much in this lecture, and we will finish this topic in the next lecture, which is on your volatility forecasting. Clear? Thank you.